Well, welcome, and good afternoon, everyone. Thank you for everyone who's joined us today for making the time to join us in this today's presentation. Very, very important and timely presentation today. So I really appreciate everyone making time to join us in this presentation. Today is Wednesday, March the 12th, and this presentation is being recorded and hope to be mailed out, released sometime next week. I would like to encourage everyone who has questions to please email them to me, and I will present it to Josh and Joe. You can email them to me at karim.visram@rbc.com. Again, karim.visram@rbc.com. Many of you have already forwarded me quite a few questions. I'm going to try and group these questions into 3 or 4, questions that I'll present to Joe and Josh. And the presentation will last probably in the neighborhood of about 30 minutes or so, and then we will have Q&A after that. So feel free to send me any questions that you have. Again, welcome everyone, and thank you for taking the time to join us. This webinar will basically focus on the escalating tariff war that we are under with the new U.S. administration and its potential impact on our economy. With policies shifting almost daily, it is a challenging time for business and individuals alike. For example, I recently read that many Canadian snowbirds may have to register with the U.S. authorities if they plan to stay in the U.S. for 30 days or more. This is U.S. administration's effort on U.S. immigration policy. So this is yet to be confirmed. To help us navigate this uncertain landscape, I'm thrilled to welcome 2 experts who I'll introduce shortly, who will share their insights and practical advice. Together, we will explore how these developments might play out and how we can prepare ourselves. One of the presenters, Joseph Wu, is a repeat performer. He's someone that I've relied on quite significantly over the last few years, and this is his 3rd time presenting. Josh, it's first, but definitely won't be the last time, Josh, that I'll be roping you in future presentation. So let me take a few minutes to introduce the 2 presenters before I pass the torch on to them. Joseph began his career with RBC in 2007 and joined RBC Wealth Management Portfolio Advisory Group in 2010. Joseph is a member of the RBC Wealth Management Global Portfolio Advisory Committee, which provides strategic analysis and financial markets and asset class recommendation, serving as a co-chair of our Asset Allocation Committee and Tactical Committee. He has been involved with management of the firm's fixed management of multi-asset class portfolios for many years. Joseph currently focuses on multi-asset strategies, helping to develop and shape our overall investment stance and asset allocation strategies. Joseph is a Bachelor of Commerce from University of Toronto and a CFA charter holder, like all of us here. Now to Josh. Josh Nye is a first-time presenter in this webinar, so welcome, Josh. Josh is a fixed income strategist with RBC Dominion Securities Portfolio Advisory Group. He conducts research on rates, macro, credit, and preferred shares, focusing on Canadian and U.S. fixed income markets. Josh advises on portfolio construction and investment strategies and provides asset allocation guidance as part of the Canadian Investment Committee and Global Portfolio Advisory Committee. He also co-manages a number of portfolios, including Canadian fixed income reference portfolio. Josh studied economics at the University of Western Ontario and has a master's degree from London School of Economics. Thank you, Josh. Thank you, Joe, for joining me in this webinar. Really appreciate you guys joining me. So let me at this stage pass the torch on to the two of you. Take it away, guys.
Great, thanks, Karim. Good morning, everyone, or good afternoon. So we're going to try to be brief with our formal presentation. I think it's probably more important that we address some of the questions that you have sent Karim. I think if we move on to the next slide, and I want to keep that relatively brief, just thinking about the key economic implications with tariffs. Again, just to keep it brief, is at the end of the day, they do slow economic growth, the degree of which will depend on both the breadth and duration of the tariffs that actually go into effect. They do reduce economic efficiencies. There is a thing called comparative advantage in economics, where some countries are just better at producing certain things. So to the extent that some of that efficiency is disrupted, overall it reduces productivity. They also raise prices, at least in the very short term, and that typically, and assuming it's not a tit-for-tat tariff for an extended period of time, these kinds of price shocks are typically one-time in nature, but it does make the jobs of the central banks a little bit tougher in terms of managing potential downside risk to growth, while at the same time dealing with some short-term upside risk to inflation. And if you kind of combine all of those factors, it's likely to have some degree of spillover effect into corporate fundamentals, which is why financial markets are kind of responding in the way that they have since the nearby peak in equity markets near the end of February. Now, I do want to emphasize a lot of these, some of the impacts that we're going to talk about are relatively short-term in nature. Trade barriers are nothing new for markets or even for corporations. And over the long term, they haven't really necessarily served as a hurdle for equity markets. The corporate sector and households as well have a good long-term track record of being able to adapt to these kinds of trade barriers over time. I think the risk here is that the U.S. administration might move too quickly, and that certainly reduces the ability of the corporate sector and households to be able to adapt to some of the changes on the tariff front that are forthcoming. Now, I think as most can appreciate, how aggressively the U.S. administration pursues its trade agenda is still a bit of an open question. We are seeing basically new headlines every day, if not every hour, and it's very, very hard to keep up with. But what is clear to us is that tariffs will likely weigh on Canadian growth, and we do have a slide on that. One thing to keep in know once we get there is that these kinds of forecasts, whether it's growth or inflation, they depend on a lot of different assumptions. And as a result of that, and also these forecasts were produced in early February when tariffs were still taking the form, mostly in the form of threats rather than actual implementation. So obviously, we've seen some tariffs come into effect, and we can touch on some of that later on as well. But I think it's worthwhile to kind of take a step back to think about, if we move on to the next slide, just to get a sense of what played out in the U.S.-China trade war back in 2018. From an economic standpoint, I think it's quite clear to us that global growth is likely to slow over the next few quarters as some of these tariff shocks get realized. And that's essentially what played out in 2018. These are business surveys for both the manufacturing and service sector. It did hold up reasonably well in the early part of 2018, but as a lot of these tariff announcements went back and forth between China and the US, eventually that started to take a toll on the confidence of the corporate sector, and we did eventually see a pretty meaningful slowdown in business activity by the end of 2028. And activity didn't really start to bottom until the first half of 2019. And I should also add that the Federal Reserve was in the process of hiking interest rates in 2018. They did eventually reverse course and start to cut rates towards the second half of 2019. But it wasn't really until the second half of 2019 when economic activity started to rebound and the Fed started to ease monetary conditions. Now, if we think about the impact on inflation, if we move on to the next slide. Again, the short-term impact here is probably a little bit higher in prices, but the degree of how much of an increase we're going to see in inflation is really up in the air right now because we just don't know what actually will get implemented. We've certainly seen the tariffs on steel and aluminum go into effect, and tariffs for goods that are outside of the USMCA trade agreement also seems to be taking effect. So in the near term, we do expect relatively higher prices. But over the longer term, once you stretch your horizon out to maybe like the 1 year mark or the 2 year mark, what matters more is whether or not demand actually holds up. And because the economy eventually slowed towards the second half of 2018 and the first half of 2019, what we saw in terms of inflation dynamics back in 2018 was an increase initially, but a pullback once that one-time shock in prices started to fade. So this could play out again this time, where over the next couple of quarters, we might see some upward pressure on inflation. And whether or not that price pressure is sustained is really a function of how intense these tariff announcements, these tariffs actually get implemented, as well as their duration. And most importantly, whether or not there's tit-for-tat tariff announcements between the U.S. and other major trading partners. But that is this rise and fall pattern in inflation is kind of the playbook from 2018. We'll see whether or not that plays out again this time around. Now, I think moving over to the next slide, and maybe here, I'll just turn it over to Josh to walk through some of the potential differences between the trade war that's just starting to get off the ground here and what played out in 2018, which was a little bit more targeted in nature, and whether or not, as well as walk us through some of the potential economic and inflation implications.
Yeah, thanks, Joe, and good morning, everyone. Thank you, Karim, for organizing this. Looking back at that 2018-2019 trade war, it was really a sort of U.S.-China skirmish. Certainly other countries were implicated, including Canada, through steel and aluminum tariffs that were put on back then, and it took about a year of USMCA negotiation to get those tariffs lifted. But generally speaking, the main target of that trade war was China, and there was perhaps some success from putting tariffs in place on a large share of imports from China, and those tariffs did actually largely remain in place under the Biden administration. And as this chart shows, the U.S.'s trade deficit with China has shrunk considerably as a share of GDP relative to 2016, just before Trump took office. But the key caveat there is that the overall U.S. trade deficit was little changed, and that smaller trade deficit with China was offset by larger trade deficits with other trading partners, particularly Mexico, Canada, and a number of Southeast Asian economies. So, I think Trump has that in mind this time around. Certainly, China remains in focus with this current trade war. They've had sort of 10% across the board tariff applied to imports from China, and then Trump recently added another 10% to that. So China, again, very much in the crosshairs, but he is sort of broadening the focus of this trade war, I think, to address some of the growing imbalances with other countries that are shown in this chart. And this is part of what makes it a bit difficult to assess exactly what Trump is trying to accomplish here. I mean, there's been talk of tariffs as a growing and potentially permanent source of revenue for the U.S. government, which they run a pretty substantial budget, and so they do need to find new sources of revenue if they're not going to curtail spending, and particularly if Trump wants to pass some of the personal tax cuts or extend some of the TCJA tax cuts that he put in place in his first administration. And so, if tariffs are really viewed as a source of revenue and trying to shift the burden of taxation away from American households and companies and toward foreign producers who, in Trump's view, should probably pay to have access to the U.S.'s large consumer base. If that's the approach here, then certainly there is the potential for tariffs to remain in place for an extended period. And as we'll get to shortly, the duration of these tariffs is really central to how we think about their economic impact. I think some of the motivation potentially is also just to reorient global trade flows and bring more manufacturing jobs back to the U.S. Whether that's ultimately feasible given labor constraints in the U.S. is another question. But again, I think Trump's got this chart in mind here where they targeted China with tariffs in 2018, but it really just shifted around that trade deficit. And if he does want to reduce the overall trade deficit, then perhaps tariffs do need to be more broadly based, and that's why Canada and other countries are more in the crosshairs this time around. If we move to the next chart here, and Karim, I know you said there was quite a bit of interest in looking at tariff scenarios and the potential economic impacts of those, and this chart is really central to that. And as Joe mentioned, this was sort of produced, right around Trump's inauguration before any tariffs were put into place, and the likelihoods of these scenarios are obviously changing day to day and month to month. So perhaps don't view those likelihoods that Karim has circled there as being set in stone or us having very firm conviction on those. That top scenario is one that hasn't really been discussed. That would be more of a China-focused trade war scenario, and that's something that Trump did campaign on, but certainly the experience thus far suggests that it's going to be more broadly based. And then back to my point on the duration being key here, that second scenario, North America-focused tariffs, that one has become somewhat more likely, but really the duration is key there, and the forecasts for that row do assume that those tariffs remain in place for an extended period, whereas the scenario just below that, which you can see we view as somewhat more likely, is that those tariffs are put in place, but only last for a few months, and there ends up being some sort of negotiated solution that sees those removed. Now, I should probably just mention where we are right now in terms of tariffs, because it's been changing, as Joe mentioned, pretty much day to day. As of now, the U.S. is applying tariffs of 10 to 25% on imports from Canada that are not compliant with the USMCA agreement. And as of now, only about 40% of our exports to the U.S. are USMCA compliant. That said, it could be quite simple for a large share of those goods that are non-compliant to become compliant. It hasn't really been worth the extra paperwork. If something was tariff-free, fill out all these forms to be USMCA compliant, it doesn't really impact things. Now, there is a substantial difference between being USMCA compliant and non-compliant, and I would expect many of our exporters who can become compliant, and RBC's economics team estimates that perhaps 90% of our exports or more could become compliant in relatively short order. Those could avoid tariffs, but for now, they are in place. And then just overnight, the U.S. applied 25% tariffs on steel and aluminum imports globally, including from Canada, and Canada has just announced some retaliation against that. Now, April 2nd is a very important date for U.S. trade policy. That's when reciprocal tariffs could come into place. That's when this sort of reprieve for USMCA compliant goods could potentially be removed, and that's when the Canadian government could also step up their retaliation. As Joe mentioned, these charts here, there are a number of assumptions underlying them. One key one is no fiscal and no monetary policy response, and There has already been some mild fiscal support announced by the Government of Canada. The Bank of Canada cut its policy rate today. I think they probably wouldn't have done so if it weren't for this trade policy uncertainty. So we are already seeing some policy support in response to this trade war and trade policy uncertainty. So important to keep that in mind, that if there is a more substantial response, then these would probably be viewed as more of a worst case type scenario. This also assumes full retaliation by countries that have tariffs imposed against them. And Canada so far has applied tariffs on $30 billion in imports from the US. There's another $30 billion in response to the steel and aluminum tariffs that have just been announced. And then the government deferred another $125 billion in goods that would have tariffs applied to them until April 2nd. And so if you put all of that together, at least $155 billion that was previously announced, that's only about 1/3 of our imports from the US. So certainly it's not 100% retaliation, which is assumed in this scenario. Then just getting
go ahead, Josh, if I can so we're looking at sort of 70% probability of the tariff being either temporary or partial tariffs, right? Even though this is about a month old or whatever, but would you give probability approximate to the same, knowing what's happened in the last few weeks?
Yeah, certainly some things have shifted around. I mean, that no tariff scenario at the bottom, I think that ship has sort of sailed, so you have to reallocate that probability. And again, the one on the top, it does seem that Trump is focusing a bit more on other countries in addition to China, so maybe put less emphasis on that one. The North America-focused tariffs, again, there are varying degrees of this. The exemptions that we have for USMCA-compliant goods, if those were sustained, then we wouldn't even really be in that North America-focused tariff scenario. It would be a milder version of that. We do still think that those scenarios highlighted in yellow there are the most likely. Either these broadly based tariffs are taken off after several months because of some negotiated solution, or some more narrowly based tariffs like the steel and aluminum tariffs that were just put on and were part of the 2018 trade war. Certainly there's the potential that those types of tariffs remain in place for an extended period of time. I guess the real challenge with saying, okay, are we in this sort of temporary tariff scenario, or is he going to enact these on a more sustained basis, is just really trying to get a sense of his motivation here. I mean, he's talked about border security within North America. I think that's generally viewed to be just sort of cover to use the International Emergency Economic Powers Act to apply broadly based tariffs. As I said, there could be some revenue motivation here, in which case they might want to keep these tariffs on for an extended period. But I think the general view has been, and it probably remains the most likely scenario, that this is really a negotiating tactic. And the challenge is, I think, Canada's trade negotiators are somewhat puzzled with exactly what Trump wants to get out of this. I mean, certainly he's raised some longstanding trade irritants when it comes to Canada, supply management in the dairy industry, for instance, softwood lumber. I mean, these are perennial trade issues. He's also brought up some newer issues like our digital services tax that was put in place last year, or perceived limits to access to the banking sector for U.S. banks. There are also some sort of non-trade things that he would like to see, like greater military spending by Canada and by other NATO partners. So, there's certainly room to negotiate with those things, but those are also some fairly complex issues, and it could be that negotiation takes some time, and we have some tariffs in place for that period. But again, we do place more or greater odds on those yellow tariff scenarios where, there is certainly a negative economic impact from those. That substantial but temporary tariff scenario where GDP is about 1% lower this is over 2 years relative to a base case forecast. I think that might be consistent with Canada's unemployment rate rising from about 6.6% today to probably something closer to 7%. So certainly not a good scenario, but a somewhat manageable one. Whereas that 4.5% economic hit, which again, we're not even really there right now with the tariffs that are being applied, and you'll get some policy offsets to this. So this would really be viewed as the sort of worst case version of that scenario. But that type of scenario might see Canada's unemployment rate rising perhaps slightly above 8% from, again, 6.6% today. So more of what you would call a recessionary type scenario.
And that would be sort of without any response from Canada, fiscal or monetary, right? Basically.
Exactly. And again, we've already seen some response. And I think in a scenario like this, you would absolutely see some additional fiscal support coming through. And then for the Bank of Canada, they'll want to gauge that level of fiscal support to determine how much monetary policy support to provide. But certainly there's ample room to cut the policy rate if they needed to do so.
Right. Okay.
Yeah, this is just a quick look at the sort of progression of a tariff shock through the economy. And, this path doesn't necessarily have to be linear. I would say the uncertainty shock can extend pretty much throughout this timeline. And you've got fiscal support sort of at the end there. That doesn't necessarily have to be the last development in this timeline. But when the threat of tariffs arises, you have this increase in uncertainty, as Joe highlighted, that can weigh on some of these sentiment indicators. And we just had the Bank of Canada's rate decision this morning. They cut interest rates, and they unveiled some new survey data that they'd conducted since their last policy meeting, showing an increase in uncertainty for Canadian households and businesses, which is expected to weigh on growth in the first quarter. At the same time, though, you also have this sort of front loading of economic activity. So we saw a surge in exports in January as our customers in the U.S. tried to get ahead of potential tariffs, and that can provide a temporary boost to economic activity, contributing to this sort of rise and fall pattern that Joe highlighted earlier. Then once the tariffs are applied, of course, that saps demand for those products that are hit by tariffs. You've also got the retaliatory measures that, again, it's not been a one-for-one response from the government of Canada, but we have placed tariffs on about $30 billion of our imports from the U.S. And another $30 billion coming in response to the steel and aluminum tariffs. So, as those take hold, that will raise prices domestically, and will probably demand fewer of those goods, and you get this sort of negative purchasing power effect as well. And then what we've really yet to see, but I think we're going to be keeping an eye on, and the extent of this is really going to depend on how sustained and how substantial that tariff impact is you get this spillover into secondary industries that are not necessarily targeted by tariffs, but when you have households pulling back on spending, or people in more impacted industries potentially facing layoffs, then you get these sort of second round spending effects that can sort of diffuse the economic impact across other industries. And then, of course, you've got that policy response that I mentioned, both in terms of monetary and fiscal policy. Just on the monetary policy side, I'll quickly say that it's a sort of challenging shock for a central bank to manage. It's what we call a stagflationary shock, tariffs. So it causes the economy to stagnate, which would the typical response would be to cut interest rates, but it also causes inflation, and the typical response to that is to raise interest rates. And so, of course, the Bank of Canada and other central banks are essentially being pulled in two directions by this tariff shock. And ultimately, it's the balance of those two forces that is going to dictate the monetary policy response. The Bank of Canada, again, cut rates this morning. I think if we put all of this tariff stuff aside, just the strength in economic we had in the late stages of 2024 probably would have seen them pause their rate cutting cycle, but they ultimately opted for a cut just to, I think, take out some insurance against the negative growth effects of this trade war. They caution that further rate cuts are not necessarily a foregone conclusion. They're going to have to be keeping a close eye on how inflation and inflation expectations evolve in response to tariffs, and whether they have the latitude to provide additional monetary policy support, or whether they need to maintain focus on their inflation mandate, and that potentially limits their ability to deliver further easing. As of now, the Bank of Canada's overnight rate is 2.75%, which is pretty much right in the middle of the range that they consider neutral. So it's neither really stimulating nor slowing the Canadian economy. And yeah, just to look back on how central banks responded last time around, the Fed was raising interest rates, the BOC, Bank of England in the UK were raising interest rates. In 2018, they were starting from a very low point for interest rates, though, to be fair. But then once we started to see the economic effects of the trade war sort of flowing through more broadly, once you had some equity market weakness in 2018 as well, that caused these central banks to move to the sidelines, and ultimately some, including the Fed, started to cut interest rates in 2019. I think we can skip over this. I can maybe highlight some of it in our discussion, but I'll just maybe highlight here that it is a much different scenario where we are right now for interest rates compared with 2018. We went through a pretty substantial hiking cycle in 2022 and 2023. That was fairly painful for the bond market, but it has left much higher yields today. And so, the cost of playing defense by, having a healthy allocation in your portfolios to fixed income, you're getting much better compensation for, going with that more defensive positioning in fixed income than you were, say, in 2018. This also means that there's scope for central banks to cut interest rates if there is a more significant growth shock, and that would cause yields to decline and provide some positive offset in your portfolio, particularly if you're holding government bonds. So just the benefit of having some safety in your portfolio if this trade war does continue to escalate.
Maybe I can touch on equity markets, given the volatility that we've seen since late February. If we look at the S&P 500, the nearby peak was February 19th, and since that date, it is down roughly 8.5% on a price basis. The TSX, since that date, over the past 3 or 4 weeks, is down about 6.5%. And if you look at international markets, they're actually flat to up on the year in the case of Europe, which is up more than 10% in Canadian dollar terms. I think part of why international markets have performed a little bit better this time around is because the initial focus of the Trump administration's trade policies have targeted North America, with Mexico and Canada being the first 2 major trading partners in the crosshairs. Our sense is that the tariffs will probably eventually broaden out to include Europe as well. And that may become a bit more of a headwind for international markets if and when that occurs. If we look at global equity markets as a whole, valuations have certainly come down a little bit over the past 4 weeks, generally with U.S. markets making up roughly 65 to 70% of global equity markets and a 9% correction there. I think instead of trading at 18.5 times forward earnings, we're now trading closer to 18 times, if not just slightly below that. So we have seen a bit of a valuation adjustment, a downward adjustment over the past 4 weeks as markets have taken notice of the increased downside risk to the economic growth backdrop. But valuations are still, in general, looking relatively elevated. So we do expect this volatility to persist until markets are able to get a handle on some of the near-term implications for the economy, which obviously feeds into corporate earnings growth. So far, the effect on earnings estimates are not meaningful. In fact, we look since February 19th when equity markets started to correct. Forward 12-month estimates for major markets, including the U.S., the TSX, and international markets have actually been stable. They've actually moved up a little bit. So with this increased downside risk to the economy, what investors have been doing recently is, for the most part, what they're saying is we are demanding a higher risk premium. So this valuation multiple has come down to account for what is obviously a much wider range of economic outcomes over the next 6 to 12 months. I think in terms of what we're doing for portfolios, I think staying invested and being able to invest through this volatility is important. Again, over the long term, trade barriers and tariffs are not necessarily new for markets. They do eventually are able to kind of adapt to the new environment, or whatever tariffs eventually get implemented and kept on for an extended period of time. There are different ways that businesses and households can adapt and adjust to that. I think what we've been doing a little bit more closely for our portfolio is to make sure that the businesses that we own are generally higher quality in nature, with more resilient cash flows, with healthy balance sheets, with pricing power. And in some cases, we also look for consistent dividend paying stocks that have the capacity to grow them over the long term. And, for the most part, those are the kind of businesses you already own in your portfolios through both the Canadian and U.S. focus lists. So we're not really doing very much in terms of the equity side of the portfolio, other than to just take a closer look at some of the businesses we own and recognize that some of them are likely to face near-term headwinds, at least over the next couple of quarters, again, depending on what tariffs actually get implemented. Over the longer term, though, these are the kind of businesses that are going to be able to compound wealth over the very long term. And obviously, our advice is to really prepare for the volatility, but making sure that we stay invested through these kinds of correction episodes. And on the fixed income side, I think Josh has already touched on that. If you look at fixed income, whether it's government or investment-grade corporates, these are generally the higher quality spectrums of the fixed income markets. The starting yields you're getting today, 3 to 5%, is considerably higher than what was available in 2018. So we do view them in portfolios that own fixed income. There's a lot of all equity portfolios out there, but in multi-asset portfolios that own a little bit of fixed income, these higher quality bonds today look like reasonably attractive and stable sources of income that can provide a little bit of an offset to the volatility of the equity portfolio, such as the one that we've experienced in the past 4 weeks or so. So maybe I'll leave it there, Karim. I'm not sure if there are some other questions that we weren't able to cover off, but we're happy to kind of go through them if there are any.
Yeah. So great. Thanks, guys. Thanks, Josh. Thanks, Joe, for a great presentation. Yeah, there's a bunch of questions that have come out. In the interest of time, I'll try and summarize. I think, the best and the most likely scenario, Josh, you covered that, so that's wonderful. But the two common questions that have come in, one that, Joe, maybe I'll throw it at you. You sort of touched on it right now, is with the volatility and the risk that we see right now, would you advise, someone to either, liquidate the U.S. holdings, or, get out of the U.S. market completely, or equity markets completely, and then go back in when things look, a little bit more safer? I know you've done a lot of research on that, whether timing actually adds any value or not, or just stick to a strategic strategy. So maybe you can touch on that. That's a few questions have come on that.
Yeah, we don't our approach to equity portfolio is to make sure that we have a good amount of exposure to all the major markets. Obviously, with the U.S. market being the largest one in the world, U.S. equities are likely to be a major component of most investor portfolios. And we do not use zero-sum views when it comes to equity markets. I think there's a reason why you want to have some exposure to Canada. You want to have some exposure to international and make sure your portfolio is just not entirely comprised of U.S. equities, because as the first 2.5 months of this year demonstrates, there are going to be periods where the U.S. market does not perform as well as it has over the past, call it 10 to 15 years. I think year to date, international equity markets are outperforming U.S. equities by roughly 12 percentage points. Whether or not that's sustainable going forward is obviously the million-dollar question, but I think it's in times like this that where diversification can really help you by providing the portfolio with an additional source of returns. It doesn't mean you need to own a lot of international equities, but having some exposure there through different strategies can make sense. I think when it comes to U.S. equities, there's a couple of headwinds to be mindful of. The U.S. economy has recently shown signs of a more meaningful growth slowdown, and we did have a chance to go through all the different growth slowdowns for the U.S. economy dating back to 2010, excluding the 2020 pandemic recession, which is really really a generational shock. Nobody can forecast that kind of stuff. But if you exclude that one, since 2010, the U.S. economy has experienced roughly 7 different episodes of, these are what markets call growth scares. And they're called growth scares because they're growth slowdown periods during an economic expansion that eventually leads to renewed expansion rather than slipping into a recession. So during these periods, during these 7 growth slowdown periods for the U.S. economy since 2010, U.S. global equity markets in general have declined anywhere between 10 to 13%. But what's interesting is because these slowdowns did not slip into an outright recession, if you look at the 12-month period performance after these slowdown periods have ended, global equities delivered anywhere between 15 to 20% returns in the year after the growth slowdown has ended. So as long as the current growth slowdown does not slip into a U.S. recession, then our sense is that over the next couple of quarters, if we start to see signs of stabilizing economic indicators that give us greater confidence that we're going to see a bit of a rebound in growth, I think financial markets would generally respond quite well to that. Now, obviously, there's an increased risk that the U.S. economy could slip into a recession. When we think about the U.S. recessions over the past kind of 20, 30 years, for a U.S. recession to occur, you either need a pretty large shock or a lot of different things all going wrong at once. I think if you do see a very broad-based trade war that's sustained for an extended period of time. So if you see tariffs, U.S. tariffs on all the major trading partners, and they're kept on for the next 6 to 12 months, that would certainly represent the kind of shock that could push the U.S. economy into a recession. It is not our base case scenario, but the risk of that is higher, and markets are adjusting the valuations based on that increased risk, not necessarily because it's become the central scenario for the economy, but more so just to recognize that the range of outcomes is wider than it was even compared to a couple of months ago, and to acknowledge that recession risks are probably a little bit higher today than they were before Trump started to levy and threaten all sorts of tariffs on as many countries as you can count at this point.
Right. The only thing, Joseph, I guess, great explanation. The only thing I would add, and your team's research and other research that I've read and done, market timing is never recommended, because to get market timing right, you got to get 2 things right: when to get out, and importantly, when to get back in. And unfortunately, the markets generally, there's, as someone told me once a long time ago, there's no bell or there's no lights go on when the market's at the bottom or market's at the peak. So what you got to make sure is both of you have noted, have solid businesses in your portfolio that can withstand some of this volatility. If you have solid businesses that generate earnings and dividends, then sometimes, yes, you can overweight or underweight certain markets, but you're better off riding through, because we generally know what the bottom of the market is after the market is already bounced off the bottom. We don't really know when the markets have bottomed or topped. Right. So, the second last question I ask in the interest of time, and either one of you can tackle, a bunch of questions on the outlook of the dollar, Canadian dollar. So if any one of you wants to touch on that, it'd be awesome.
Yeah, I can start with that one. Yeah, I mean, the Canadian dollar has been, surprisingly stable over the past few weeks. I mean, if I think back to February 3rd, when it initially looked like Trump was going to apply broadly based tariffs on Canada and Mexico, we jumped up to like 1.48 for dollar CAD, which was kind of through the highs that we saw or lows for the Canadian dollar back in the 2015-16 oil price shock. So a pretty substantial reaction to that. And then ultimately, we got the 1 month reprieve from those tariffs, and dollar CAD came back down. And again, some of those tariffs have now been put in place. There is this exemption for USMCA compliant goods, which again could theoretically be the majority of our trade with the U.S. But there have been some tariffs that have been put in place now, and we're still hanging around the $1.44 mark in terms of dollar CAD. So not all that different from where we were sort of earlier this year, prior to Trump really looking like he was going to follow through on some of these threats. Now that is higher. The Canadian dollar is weaker than we were, sort of in the third quarter of last year, say, prior to this U.S. dollar appreciation associated with the Trump presidency. And that itself reflects the hope for growth positive policies out of the U.S. administration, deregulation, tax cuts, those types of things we're seeing as supporting the U.S. dollar, and then also the potential for tariffs. And when a country applies tariffs like the U.S. is doing, that tends to contribute to their currency appreciating. Now, one of the reasons probably that the Canadian dollar has been stable recently is that the U.S. dollar is starting to come off of those highs, and that reflects, as Joe mentioned, there some signs of softening in the U.S. economy. Then also, I think he touched on sort of EFI equities performing fairly well. So this sort of end of U.S. exceptionalism in terms of both growth and equity market performance has caused the U.S. dollar to soften somewhat, and that's probably why the Canadian dollar is holding its ground. As for the future direction, I think it is really going to depend on tariff policy. If Trump follows through on April 2nd on some of his threats to increase tariffs or remove that exemption for USMCA compliant goods, certainly we could see the Canadian dollar weaken further, dollar CAD rise further, perhaps even toward those levels that we spiked to initially in early February. If, however, we get some tariff relief, then you could see the Canadian dollar start to appreciate. The Canadian dollar is undervalued on a sort of long-term fundamental basis, and so the sort of long-term direction of travel should be Canadian dollar depreciation and that U.S. dollar CAD exchange rate coming down somewhat from the current 144 level.
Well, thank you, Josh. In the interest, there's a whole bunch of other questions. Sorry, wasn't able to get to all of them. I will get the answers from Joe and Josh and email it to her. But if anybody else got any questions that were not answered here, please feel free to email them to me. Again, Karim, joe.visram@rbc.com, and I promise to get your answers from Joe and Josh. But in the interest of time, we will probably end here. Joe, Josh, thank you so much for your time in preparing this presentation and being here with us and sharing your expert opinion on this. I really appreciate your time and everything. Thank you for everyone who joined in this presentation. The recording will be released hopefully by next week. I'll email it to everyone. That we're also having another webinar on the same topic tomorrow. I'll send out further details and invites. So hopefully all of you can join in and everything. Again, in the interest of time, I'm going to end here. But thank you everyone for taking the time today to join us in this webinar. Thank you, Joseph. Thank you, Josh, for your expert opinion, expertise, and your time. Really appreciate it. Have a wonderful day, everyone.
Thanks, Karim.
Okay.
Thank you.
Take care. Okay, bye-bye.
Bye.